Hey there, investors! Welcome to our channel. If you're someone who's looking to make your money work for you, then you've come to the right place. Today, we're diving into one of the most powerful strategies in investing: dividend investing. Dividend investing is one of the most reliable ways to build wealth over time, but a lot of people don't fully understand how it works or how to get started. In this video, we'll cover everything you need to know about dividends, how to choose the right stocks, and how to build a portfolio that pays you back regularly. Whether you're just starting out or you've already got some dividend stocks in your portfolio, stick around because by the end of this video, you'll have a solid understanding of how to maximize your returns with dividends. Section 1. What are dividends? Let's start with the basics. So, what exactly are dividends? Dividends are basically payments made by companies to their shareholders, usually in the form of cash or additional stock. Companies that generate profit can choose to reinvest that money into the business, pay down debt, or distribute it to shareholders. When they choose the latter, they issue dividends. Think of dividends as a way for companies to share a portion of their earnings with you, the investor. For example, let's say a company earns $1 million in profit. After covering all their expenses and reinvestment into growth, they might decide to give 40% of that to their shareholders as dividends. Dividends are often paid on a quarterly basis, but some companies might pay monthly or annually. And while the amount can vary, the beauty of dividends is in their consistency, especially if you choose dividend-paying stocks that have a solid history of reliable payouts. Section 2. Why invest in dividends? So, why invest in dividend stocks in the first place? What makes them such an attractive option for long-term investors? There are a few key reasons. First, dividend stocks offer a steady stream of passive income. That means you don't have to sell your shares to realize gains. You get paid just for holding the stock. Second, dividends provide stability. While stock prices can fluctuate, dividends tend to be more predictable. Companies that pay regular dividends are often mature and financially stable. And here's a big one: dividend reinvestment. Many investors reinvest their dividends automatically to buy more shares of the company, compounding their returns over time. That's where the real magic happens, especially when you combine reinvested dividends with long-term growth. Section 3. Types of dividend stocks. There are different types of dividend stocks to consider. Not all dividend stocks are created equal, so let's break them down. First up, we have high dividend yield stocks. These are stocks that pay a high percentage of their price in dividends. A 5% yield, for example, would mean that for every $100 invested, you'd get $5 a year in dividends. Sounds good, right? However, high yields can sometimes be a red flag. If a company's yield is much higher than its competitors, it could be an indication that something's wrong. Maybe the stock price has dropped, or the company is struggling. So, always be cautious of stocks with too high yields. On the flip side, we have dividend growth stocks. These are companies that not only pay dividends, but have a track record of increasing their payouts year after year. Companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson are famous for this. Over time, these small increases in dividends can add up to massive growth. So, which one should you go for? It really depends on your investment strategy. If you want immediate income, high dividend yield stocks might be more appealing. But if you're focused on long-term wealth building, dividend growth stocks can provide a more powerful compounding effect. Section 4. How to choose dividend stocks. Now that you know about the types of dividend stocks, the next question is, how do you pick the right ones? Let's talk about the key factors to consider. Here are some important factors you want to look at when selecting dividend stocks. 1. Dividend yield. Like we said earlier, this is the amount the company pays out as a percentage of the stock price. Look for a reasonable yield. Too high could be risky, too low might not provide enough income. 2. Dividend payout ratio. This tells you what percentage of the company's earnings are being paid out as dividends. A high payout ratio might mean the company is stretching itself too thin, while a low ratio could indicate room for growth. 3. Dividend history. A company with a strong history of paying and growing dividends, like the dividend aristocrats, is often a safer bet. For earnings stability, look for companies with steady and predictable earnings. Volatile earnings can lead to unpredictable dividend payments. 5. Debt levels. Companies with high debt can be risky, especially if their cash flow dips. Always check the debt-to-equity ratio. Tools like dividend stock screeners can help you filter through options and find stocks that meet these criteria. But don't forget to do your own research before pulling the trigger. Section 5. Building a dividend portfolio. Let's talk about how to build a dividend portfolio. There's no one-size-fits-all approach, but here are some tips that can help you structure your portfolio. First, you want to diversify. Don't just load up on one sector. Try to have exposure to multiple sectors, like consumer goods, healthcare, energy, and tech. This way, if one sector hits a rough patch, you've got others to balance it out. Second, consider dividend reinvestment plans (DRIPs). Many companies allow you to reinvest your dividends automatically to buy more shares, sometimes even at a discount. Third, review your portfolio regularly. If a company cuts or suspends its dividend, you'll want to reassess whether it's still worth holding. Keep an eye on your investments to ensure they continue to meet your goals. Section 6. Risks and challenges of dividend investing. Of course, dividend investing isn't without risks. Let's quickly cover some challenges you need to be aware of. First, dividends are not guaranteed. Just because a company has paid a dividend for the last 50 years doesn't mean they'll keep paying it. Economic downturns, financial struggles, or a change in company strategy can all lead to dividend cuts. Second, tax implications. Dividends are typically taxable, and depending on where you live, they could be taxed at a higher rate than long-term capital gains. Be sure to factor this into your strategy. Lastly, inflation. If inflation outpaces your dividends, your purchasing power could actually decrease, even though your income is growing. So, to wrap it up, dividend investing is a fantastic way to build wealth over time, but it's important to approach it strategically. By choosing the right stocks, diversifying your portfolio, and staying on top of changes, you can create a steady income stream that works for you. Remember, the key to success with dividend investing is patience and consistency. Reinvest your dividends, stick with quality stocks, and over time, you'll see the benefits of this powerful strategy.